Welcome to the VRIC Media Channel, the most trusted voice in the metals and mining market. Today, my guest is Lobo Tiggre, and we talk about the number one reason that investors lose money in the junior mining sector. You're not going to want to miss this interview. We also go through commodity by commodity, gold, uranium, copper, silver, where he's allocating cash and why, what he's not allocating cash towards and why. Lobo will be joining me at the next Commodity University Masterclass. That's on Monday night, June 30th, 5 p.m. Pacific time. If you want to join us every month, Commodity University students join myself and the other instructors for a monthly masterclass. And we just have general Ask Me Anything sessions. We look at deals together, bring your questions to the experts, and we have a jam session on how we're going to make a pile of money in this budding junior mining market. If you want to join the Commodity University, join thousands of other students, a catalog of educational courses to sharpen your skills as a mining investor, new courses delivered every single month, and of course, the monthly masterclass. Hit that link beneath this video. More importantly, here is Lobo Tiggre. Enjoy.
This is Jay Martin.
All right, here I am with Lobo Tiggre. Lobo, it's great to have you back on the program. Good to see you again.
Always fun, Jay.
So here's where I want to start. You're the independent speculator. You're deep in the weeds with junior mining stocks and commodities. I'm always curious, like when big geopolitical events happen, how you process those, because there's been no shortage, obviously, of major headlines in just the last week alone. You go back further, there's plenty to choose from. How do you decide what to pay attention to? And then in tandem with that, what are you paying attention to most right now from a macro geopolitical standpoint?
A couple of completely different answers. And one is, I'm not a military expert. I'm not even an economist. I'm not even a geologist, though I play one on TV. I'm a due diligence guy, and people pay me money to kick rocks and tell them where I think the stocks are going. And if I get into the macro and everybody asks, so where do you think gold's going? You kind of, in self-defense, you have to think about these things because you can't trust what you see on the mainstream media. Vancouver Resource Investment Conference media is different, of course. But so and mainstream economics, they have these huge blind spots that they refuse to acknowledge. So for example, right now, as you ask this question, we've got the Fed guiding for higher unemployment and higher inflation. These two things aren't supposed to be possible. Their models are that economic growth comes from or results in inflation. Inflation is an indicator of economic growth. So you throttle the economy, increase unemployment to control inflation. So stagflation, that's not even possible in their models. And yet we know it's real, not just because of the 1970s. Currently, the UK and Japan are demonstrating it. So this isn't just a theoretical academic problem. This is a real world problem that they refuse to acknowledge. And therefore, the resource investor or any investor or speculator, you have to think about these things for yourself and think what makes sense to me. And so that's the lens when I look at these things. I try to have some humility about them. When Trump got on the air and announced that he had bombed Iran, what kind of, if you had told me that would happen a year ago, I would have thought, okay, Monday, markets will open to triple digit oil. And instead, oil drops 7.5%. Like, what kind of world is that even possible? And I remember I'm not taking distant memory, I remember this weekend, when that news broke, there were oil bulls like, yeah, I'm so glad to be long. We're going to make so much money. The markets are going to go gonzo Monday. And then what happens Monday is a bloodbath in the oil patch. So one has to, on the one hand, think for one's health and have enough self-confidence, arrogance, whatever, to, to filter the mainstream and think for yourself. But at the same time, you can't believe your own BS. You have to have humility. You have to be nimble in the face of data. I want to sound like Powell with his data dependency. But you see what I'm saying? You kind of have to go in both directions here, because if not, you're going to get blindsided. And if you believe too much in your independent thinking, your independent speculation, then you get taken to the cleaners. Who would have thought, if the markets had been open Saturday, I might have bet on oil prices going higher. And it's only because I couldn't that I didn't and got saved by the bell.
What do you have a theory there? Like, what would you make of that? Because, it seems that every situation that could have occurred, yes, Israel and Iran sending bombs back and forth, then it escalates with the United States engaging and sending bombs over themselves. Then it escalates with the threatening of shutting the Strait of Hormuz. I mean, everything happened that should have caused oil to bounce significantly, and it didn't. And what's your take, Lobo? Do you have one, or do you bother to speculate on things like that, or do you just play the hand that's in front of you?
We can guess. Yeah, mostly the latter. Like it didn't. I've been so I was saved by the bell, you could say, because the markets were closed, but it wasn't just that. I hadn't been really. I have one oil stock in my portfolio, and it makes money anyway. But so I've been waiting because even though, Rick Rule and our friends, the case for oil is very strong. And I agree, peak oil probably isn't peak oil use, may not be here until 2060. Who knows? We're still going to need oil. And the industry has faced this political incorrectness for capital, starving it of capital until Drill Baby Drill came along. But, we haven't drill baby drilled. The oil prices went down anyway because it's still in a glut mode. And OPEC Plus started ramping up, and not just ramping up, they announced they're going to quadruple the rate of ramping up. And it makes you wonder, like, when that happened, that just made no sense. And you wondered, what did Trump tell them when he visited to get them to do that, if that's what happened? Why
Right.
would they do that? And then this whole thing with Israel and Iran happens, and you got yourself, and I found myself wondering, well, maybe that's what it was. They knew this was coming, and they figured maybe certain amounts of supply, especially from Iran, would get taken off the market. So we're going to ramp up elsewhere. We're going to take advantage. So I don't know this is happening. I'm not saying my secret sources in the CIA figured this out, but it's the kind of thing that might explain what we saw, which otherwise seemed, counterintuitive. Right now, I just WAG, wild ass guessing. But we precision bomb with these bunker buster bombs right on top of this site, and there's no radiation leak. Mm-hmm. And now, Trump says, "Oh, it's fake news if you question the complete obliteration of Iran's nuclear program." But you bomb the nuclear program where they're alleged to have enriched to 60%, and there's no signs of increased radiation. Something here is not working right. So Doomberg calls this performative, and it's conceivable to me. I'm not saying I know this. I don't know what Doomberg knows, and I'm not speaking for him, her, or it. What do you call a green chicken? But it strikes me that if the powers behind the scenes in the back channels were looking for a way to de-escalate, you let Iran know we're going to bomb this place. They move all the material, you bomb it, and you can say, hey, we did this. And Iran goes through their performa thing, which was, maybe Trump let the cat out of the bag, thanking them profusely for warning them where they were going to shoot their missiles, But
Yeah.
anyway, so everybody's done their bit, and they can say, oh, yeah, we were super tough. And they can go back to their respective audiences and say we did the right thing. And maybe that allows us to de-escalate. And maybe the market, or some of the players in the market are smart enough to see that. And so the market is clearly betting. As you and I record, we're looking at not 1,000-point day on the Dow, but a very, very risk-on market. And it seems like there's a lot of money out there that says that's it, it's over, it's done with. So you can put any story you want on that. But the takeaway here is, if it is done and it was all theater, maybe that's for the best in a way. Things could have gotten really ugly, but I don't think it really is done. I mean, as people keep saying, you can't bomb Iran's knowledge of how to enrich out of existence. I mean, you can't just kill a few top scientists and that ends the program.
Right.
So,
yeah.
And their motivation to continue now deeper underground, figuratively and literally, would seem higher. So, I'm never mind the politics. As an investor, it would be great news for the markets and everything if it really is done, but who knows? Hotter heads may prevail. It's at the very least, I think it is risky to bet big. I wouldn't bet the farm on saying this is it. The Middle East is done, and now we're going to peace will break out forever. Now, that seems like a pretty tall order to fill.
Yeah, I'm with you. Okay, so let's pivot to let's look the same direction that a lot of mainstream generalist investors are suddenly looking. You and I have been talking about gold for years, but suddenly a lot of other folks are as well. Individuals like Jeffrey Gundlach or Nassim Taleb saying gold is the new reserve currency. There's two ways to feel about that, and I've seen some of your posts. This is actually making you nervous, right? As a contrarian, when you see the masses turn towards the contrarian bet.
Well, to be fair, sorry to jump in, but Jeff Gundlach, he owned gold for years. And he's been a little bit hotter on it, a little bit cooler on it sometimes, but he's owned it for years. So this wasn't new. So when he said, gold's not just for lunatic survivalists anymore,
right.
I really don't think he was trying to be insulting there. I think it was a self-deprecating remark. Like, I joke sometimes about tinfoil hat Lobo, right?
Sure.
I think that's the way he meant that because he's owned it for years. But for him to say that it's going mainstream the way he did in that Bloomberg interview, you could see the interviewer was taken aback. Like, what?
Yeah.
And the Nassim Taleb one, that was a bigger U-turn. As far as I know, he's never been a gold bug.
Right.
And he's bombastic. He makes a big pronouncement. Oh, it's now the reserve currency. That's a bit of a stretch. But his point is generally right. And to your question, sorry, I kind of cut you off. But as a contrarian, when major mainstream voices start echoing your position, you have to wonder, where are we at in the cycle? Mm-hmm. And my answer to that is, past never repeats entirely. If you're in uncharted waters, it's dangerous to pull out your charts of what's happened in the past. But typically a major bull cycle ends in this blow off top, right? Where everybody's talking about it. And so if that's where this market ends, we're clearly not there yet.
No.
I don't think you were there, but I was there in the 70s, when the shoeshine boy would talk to you about gold or silver. And I was that shoeshine boy. I wasn't buying ounces of gold, but I was buying, silver rounds with my lawnmower money and babysitting money and all that stuff. So, we're nowhere near that. Where you go into a bar and everybody's talking about gold and stuff like that. We're far, far from that. And a blow off top without retail participation just doesn't seem likely. So it makes me nervous, but not so nervous that I'm done with gold or pivoting to something else yet.
Yeah, I'm with you there. And that's kind of how I interpret it as well. When you see somebody like Nassim or, a handful of other generalist investors, yes, I mean, he's saying something sensational like this is the new reserve currency. That matters less than the fact that there's more buyers coming to the marketplace. That's kind of what it symbolizes to me. More people are just talking about where they're putting their cash. That's more demand, right? We know what happens in a supply demand dynamic. But you're right. From a retail front, I mean, I was just traveling with a buddy of mine. We were in Indonesia. He's a very successful real estate investor in Vancouver. Smart guy. He's in the markets. And we started talking about the gold sector. And the comment he makes to me is, isn't it crazy that people still buy gold? And that's what he said. And this is, a wealthy, intelligent, successful individual. That's how he looks at the gold sector, as illogical. And it just struck me that that's how long our industry has been out of favor. A lot of people don't even understand why it still exists, but that's the upside to still be captured, right? Like, as you mentioned, retail hasn't shown up yet. I'm like, man,
the barbarous relic and all that.
Staring me in the face. Yeah, exactly. Right. So,
but they may not for long. My partner / COO, CFO, CTO, et cetera, was in Spain during the recent power outage. Major power outage. I mean, here in Puerto Rico happens all the time. Right. But for Spain to go into a blackout for a couple of days or however long it was quite impressive. At first, it's just sort of quaint, people out there with candles in front of the cafes and so on. But then it continues. And how much cash do you have in your pocket? Right. And if the cash registers aren't working and, all you've got is a bottle of water. Okay. It's funny for a lunch or something like that. But if it goes on for a couple of days, mm-hmm. And recently there were videos on YouTube, I haven't proofed them, but of people in Tehran with the ATMs all shut down. They're trying to flee Tehran. How much cash do you carry around?
Right. Totally.
And the ATMs are all offline. What do you do? How do you take your family and load up the truck and move to Beverly with no cash?
Yeah.
And so I think this sort of thing serves as a reminder that, silver is the word for money in so many languages. Gold is money, so much so that central banks are buying it left and right, right? And in a world like that, I can see more people changing their tune and thinking, you know what? It wouldn't be bad to have physical money that governments can't print. And by the way, no offense to my Bitcoin friends, but that still works when the lights go out. Like there is a use case here for monetary metals. Even if I, was big into the crypto scene and invested heavily there, I would probably still want, in the same way mainstream people will hedge their portfolio with a little bit of real assets, hard money. If I was a Bitcoiner, I would want to hedge my portfolio with a little bit of physical money that even if I think Bitcoin's going to rule them all in the world, like the One Ring of Mordor, right? In the end, I would want something physical that works when the lights go off, just in case.
Yeah. 100%. And what you said is dead accurate. I grew up with a lot of Iranian friends, and some of whom have wealthy families back in Tehran. And I was chatting to all of them last week. And money or not, you were stuck. It didn't matter. You couldn't get out of the city, right? There's nothing wealth in an account somewhere could do to help you, right? The shortages were cash and fuel and highways that you just couldn't. They were just blocked, from outbound traffic that had run out of gas. And then so let's I could say that the gold cycle is moving somewhat predictably low, but I'd love to know your take on this. In that most market cycles have one pillar idea that takes off. In this case, physical gold. The price, leads the way, and then the what's next opportunities start to chase it. And in precious metals, that's typically the commodity runs, then the producers of that commodity runs, then the smaller producers run, then the near-term producers, et cetera, down the value chain. Would you say that this market, even if it's not moving as fast as some investors would like it to, down to the juniors, it's moving in a predictable way, right? Sequentially from the hard asset through to the major producers, the mid-tiers, juniors, maybe the funded developers are catching a bid right now. How would you read the gold market from an equity standpoint?
That is the conventional wisdom. But as we were just saying, it's very dangerous to pull out your chart of what's happened in the past in uncharted waters. And we really are. What's going on right now has 2008 put us in uncharted waters. And then the COVID lockdowns, blew those, those new charts with expanded scope, blew them out of the water. Where the heck are we now? So I do think this is dangerous. And it is notable that, you'd say, oh, well, gee, that, the trickle down, has to happen, how crazy can gold go and make headlines without it trickling down? Well, gold went from 1,300 to over 2,000 and then stayed there. And then that did squat bupkis for the juniors. The trickle down thing never happened. So, well, never. I will say, as a due diligence guy and a stock picker, the better stocks did get some joy. So it's not true that gold stocks never responded to gold until recently.
Yeah.
But maybe that's a point worth dwelling on a little bit, because the ones that responded better, just look at the majors and what happened last year. There's one major above all that's really known for operational excellence, and that goes to all-time highs last year. And there are other majors that have political problems or operational difficulties, and they barely keep up with the GDX. This isn't rocket science. Like, this actually makes sense. Mm-hmm. And I know that you've talked to Rick about how the producers managed to turn a 7-fold increase in gold in the last big bull market into increasingly negative free cash flow. And he likes to joke that took real talent.
Yeah.
So in a world like that, and you're a serious investor, and your recency bias is that the gold producers flubbed higher gold prices, why would you rush into the stocks?
Yeah.
So in this world, I think it makes sense that there was a delay, and the producers needed to show that they could have some discipline and actually succeed at the business and not just ride on the coattails of gold. And they have. Even the ones with the operational difficulties, the political problems, have been delivering wider margins. And the trickle down is starting. And you definitely see it on the, some of the mid-tiers, the better ones, the developers, the takeover targets. That's all happening. On the junior end, even amongst the, these, as Doug Casey used to say, crappy little mining stocks, you're starting to see that rising tide stir all those ships. And the ones that have actual, discoveries, they are responding to the gold price. The ones that don't yet, not so much. And one more thing though here, Jay, this is optimistic. Yay, the rising tide's going to lift all our ships. Well, A, it didn't when gold ran up to 2000. So keep that in mind. And B, quoting Doug Casey again, he used to call the juniors the most volatile securities on earth. And this was a good thing. If you're seeking alpha and you catch the wave right, there was nothing that could make your money go crazy like, a 10 bagger, 20 bagger, or Doug has had 3 100 baggers in his career that I know of before cryptos. And that's where I'm going with this. If you're seeking alpha, if you're chasing a flavor of the day and piling into something that has high volatility that can really make me a lot of money, it used to be that there was almost nothing that could hold a candle to, crappy little mining stocks. But now there is. A crypto coin can go up 100% in a day based on some random headline about the SEC doing this or not doing that. So the kind of money that would have piled into crappy little mining stocks might be happy to play in that crypto paddling pool because there's much more volatility there if you get it right. This isn't a prediction. I'm just saying, Jay, that it's dangerous to assume that things have to go the way they did before. Now, the good news for me is I'm not just betting on a rising tide lifting all ships. I never buy ETFs with baskets of stocks. I'm a stock picker. And I do think that for people that, going back to the majors before, it didn't really take me or, a due diligence guy or anybody to distinguish, which of the gold producers that are known for delivering, quarter in, quarter out, and which are the ones that are troubled. And all you had to do was bet on the one known for operational excellence, and you made a ton of money in 2024 before, the breakout to 3,500. Mm-hmm. So I think I've wandered a bit from your question, but the takeaway is I'm very bullish on this whole space, but there are reasons to be cautious. And that means that you can't be lazy. This is not heck, just look at the news cycle over the last week. Yeah. This is not a time for passive investing. This is a time for due diligence and stock selection.
I think that's great. And I think that's the sign of a healthy market, that not every company is getting rewarded, right? But some of the good ones are, but you have to be doing the right things, have something. You can't be.
That's a good point. I think it's actually better. In a sense of, as a free marketeer and a person who believes in, markets and price discovery, the rising tide shouldn't lift all ships. The ones that are actually seaworthy and have captains worth betting on, those should be the ones that should do better. So if that's the market we're in, that's good news for people like me.
It's good news. Yeah. And, if and when a rising tide does start lifting all ships, it's a red flag to a degree, right? I think to a large degree. That's a sign that those of us who were here before it was cool should probably start finding the exit door. So let's run through a couple other metals. Love to get your thoughts. Maybe we'll stay high level unless there's one that you're super excited about, but I want to get your take right now: uranium, copper, and then we'll get into silver at the end here. Copper performance since the last time we spoke on stage in January. You had a long-term high conviction thesis. Has anything surprised you? Has anything changed, Lobo?
Yes, actually, people were congratulating me on my call for copper being my highest conviction trade for this year, and then it goes to hits an all-time high, at least nominally. But that didn't happen for the reasons that I thought. I have to admit, it happened faster and not for the reasons I thought, and it turned out not to be sustained. So don't congratulate me for that. My thesis for copper is basically that all paths lead to inflation, great big beautiful bill, remilitarization, not just of the Europe, but also I think Fortress America is Trump's agenda. All this stuff's going to take a lot of copper. But it's still Dr. Copper. It still responds to the economy. The turbulent change and economic retooling that Trump is attempting to achieve, I think, is a headwind in the near term. So I was accumulating money to put into copper later, not sooner. I did not benefit from copper's big run up earlier this year. But but the good news is, if you missed that, and you think I'm right, well, all the reasons to bet on copper are still in front of us. So I'm still building cash, and I'm looking forward to deploying more in this space. But if anything, it's interesting that copper has done so well. It corrected, but not really that much. It's still relatively elevated at a time where you would think, weakness around the globe, and even the Fed is guiding for a weaker economy, which they almost never do. Those would normally be bigger headwinds for Dr. Copper, and that they're not tells us the market is, the other side of the coin is, okay, all this demand that I was talking about, but on the supply side, unlike say oil that we were just talking about, there is a structural supply constraint on copper. It's not that the big producers are voluntarily constraining supply. They can't produce enough. They're mining all they can, and these great big mines that we're going to need, they're not enough of them in the pipeline. So all of this is bullish for longer ahead of us, but in the near term, there's questions. So the fact that copper is holding up so well now tells me, well, maybe that long-term bull thesis is coming to pinch. That squeeze is happening faster than I expected. As we speak this morning, I saw a headline on mining.com about LME stocks, copper stocks going way down. Now, that signal can come and go.
Right.
But it's interesting to see it at this time. I'll tell you, Jay, if I wasn't a newsletter writer with 20,000 best friends looking over my shoulder, I might just buy some of the best copper stocks now and just not worry about what happens next. I'm so confident of where that trade is going over the years and even decades to come that I could see doing that for the kind of company that you're not worried about it going away. But if I do that in public and people buy in and they, the Trump session hits hard and copper drops under $4, it heads for $3, and the stocks take it on the chin, I'll get no end of hate mail. So it's not the hate mail.
I get it.
Some people will panic and they will sell and they will lose money when there's no need to. And I don't want to participate in that. So I'm cautious about this. I don't pretend to know where the bottom is, Jay, but I suspect it's in front of us still. And if not, plenty of time to invest. But
let me ask you a question.
That's where I'm at.
Because I totally get what you're saying, and a lot of it takes a strong stomach to hold a position through a 50% drawdown, right? Simultaneously, all of the biggest wins I've had in the market have taken way longer than I thought they would, and went south before they went north. And our mutual friend Rick Wool, I think, has said like verbatim, every 10 bagger he's ever realized in his career, aside from one, saw a 50% drawdown first,
or
right?
more.
Or more, exactly.
His most famous one is Paladin Energy back in the day. I think he's one of those people that participated in the gazillion bagger that turned out to be.
Yeah.
But if you hear him give these interviews, you may have done this. Like he had like a come to Jesus moment with that, where he's like, I don't know, 90% underwater, right? His penny stock goes to 1/10 of a penny. And he's like, well, am I right or am I wrong? If I'm right, and wow, did he average down on that one, and it turned into an enormous amount of money when they delivered.
So you need a strategy to deal with that, because it's going to happen and it's going to be hard. And it doesn't matter so much how long you've been an investor. Managing your emotions is like the toughest part in an industry as volatile as this, where you can benefit from that volatility if you can withstand it going both directions. And, so we have the Commodity University, we just published your new course, Geology for Mining Investors. And we do a monthly meetup with all the students, and we kind of talk about, just ask me anything questions effectively. And last month we went over a worksheet that I use where it's like any position that I buy. And this is just like lessons I've learned from honestly yourself and several others in the industry as I was coming up here. It was like, you need to have some kind of an accountability measure for your portfolio. So if you build a position in a company, you've documented why you did that. You've documented if it's speculative, maybe the catalyst that may realize a share price increase. You've documented the things that could occur that would make you sell. And you documented your time horizon. So your expected duration, and if that is 3 years, then does it matter so much what happens inside of 3 months? Well, in theory, it shouldn't. In reality, it does. It's hard. But having that document will make it a lot easier to stay the course, right? You must, I know you have similar protocols and amazing resources, by the way, on your website. But walk me through how you manage that process, Lobo.
So a couple of things. One is there is a temperament issue here. And I'm sorry to say, we want to be egalitarian and, everybody's equal and so on. But there are individual differences. And some people, they're probably just not suited emotionally to being hardcore speculators. And I don't mean to sound exclusive, but I just think that's true. There's some people that they're so emotional, they get so upset over the volatility that it would probably be better if they just, bought an ETF and didn't worry about it, right? But for those who can go there, I do actually think that it's not that bad. You don't have to be some kind of, freak of nature, Mr. Spock with no emotions or something like that. There are things you can do. Discipline is a muscle, a mental discipline. You can exercise and develop it. And the number one thing I find is that if you limit your portfolio to a number that you can really understand and follow, like educate yourself about this, the more you know, the easier it is to ride out that volatility. Like if you know that this is a world-class copper deposit they're developing, like they've already drilled off, hits, hundreds and hundreds of meters apart, great big hits. And okay, there's still a lot of feasibility work to do or whatever, but they've got something big. And this is going to be a many years story of lots of value added. I mean, like let's say the Philo story of recent copper success. If you're involved in something like that and copper goes down this month, I mean, it's almost like, who cares? Maybe you're looking at something that's going to be like a 40 or 50 year mine life. It's a company maker even amongst larger companies, that sort of thing. Like really, who cares what copper does this month or even this year when you have something like that? And I'm not trying to pick favorites there, but I am saying that level of understanding, the more you understand the specific speculation you made, the easier it is to tell from Shinola. Like, this news does not matter. This news does not subtract value. This news doesn't change anything about my reason for owning this stuff, or it does. If it does, well, I got to sell. But if I know that it doesn't, I can ride the wave out with. And it's easier to do when you know than just, I bought it because Lobo said so, right? So I really think that's very important. And then there's some specific strategies, like I think about my upside maximizer strategy. People often say, well, how do you know when to take profits, or how do you time the markets? And I don't know. When is gold going to roll over? I don't know. But this upside maximizer strategy, it's a mathematical approach. And I'm going to, when things roll over, my upside maximizers will be triggered and I'll sell anyway. And I don't know where the top is, but if it turns out there is a big top, that will trigger a lot of these upside maximizers. And I won't close my whole portfolio down, but I will have taken a lot of profits. I will have sold a lot of stocks. And then in hindsight, I'll say, oh yeah, that was the top. But guess what? I didn't need to know it at the time. So a strategy like that, it's basically like using a stop loss, but not to prevent losses, but to lock in gains. And there's a free report on the website, Upside Maximizer. You can look it up. Things like that, they help you sleep at night, because instead of having to have your finger over the switch, what's right? The math helps.
Let me ask you, do you use stop losses in your general portfolio, Lobo? Money stocks? No, neither do I.
And there are not just mainstream, but there are famous investors in our space that insist on stop losses. And, maybe if I was one who loaded up mostly on the larger companies, maybe I would.
Right.
Because if you've got a Wheaton or a Franco or a Barrick or a Newmont or something, and they drop dramatically, probably something happened. A company like that doesn't drop 30% just because gold fluctuated. Something got nationalized, or the legendary endangered mosquito was discovered in their headquarters or something, right? Something happened. So I could see it maybe if that's where, but mostly I'm invested in the juniors.
Yeah.
And they're so volatile that a stock like that, they can drop 30%, 40%. because somebody's having a bad day, or some major shareholder is going through a wicked divorce and they're forced to sell, or something that's completely irrelevant. That therefore actually means that was a buying opportunity. You can find yourself liquidating at the very time you could have maximized your upside by buying on that mistaken move.
Yeah.
So yeah, just the nature of my portfolio, I prefer to pay attention. This is what I do. I do nothing else all day. I'm watching the markets and I'm thinking about rocks and stocks. So if something happens, I'm going to know it and I'm going to take action. And I'd rather decide for myself than have the machine do it for me.
You just nailed it, though. I prefer to pay attention, and again, like this question actually came up on last month's call, and one of the students asked me if I use stop losses and how I use them, and I had the same response. I was like, actually, I don't, because I expect volatility to the downside, so I don't want to be shaken out. But as I was thinking about the question afterwards, I also had this second thought. It was like, it's almost, it could make you feel falsely secure if you think there's these tools and technical tools that I can lean on that will keep me out of trouble, so I don't have to do all the diligence because the stop loss will keep me safe, right? And you just said, like, no, I prefer to pay attention. That's my strategy, right?
Think about it, Jay. If you approached in a highly volatile sector like ours, if you approached it, I'm putting stop losses on everything. And, let's say you set our stocks are so volatile. You can't set a de minimis stop loss. If you set it at 5%, you're going to get stopped out of everything within a day or two, right? So let's say you set it at 15 or 20%, and there's a volatile month. You get stopped out of everything. You lose 15 to 20% on everything, and then you do it again, and then it happens again, and then you do it. Like, you could actually, nickel and dime yourself to absolute death. Just piss away the whole portfolio with stop losses. At times it actually might have made sense to double down. And so, yeah.
I love that.
I think we're in agreement here.
100%. Okay. So just trending back to copper, you walked us through your present day strategy, currently effectively collecting cash to deploy into the copper sector. What's the segment, Lobo? What kind of companies, what stage, what's the criteria? What are you looking for right now in the copper space?
Well, I mentioned already that I have a sort of barbell approach, and I like a combination of a few of the big names and then some juniors to really deliver, potentially seeking alpha there. But this is a little bit tricky. Like, that makes sense. That's my general view for all of my resource investments. But copper is tricky because of, the kind of copper discovery that matters. They're never small mines. And that it has to be good enough to interest a major, because the junior is not going to build it. If you got a copper project that matters has a multi-billion-dollar capex, and unless your name is Friedland or something like that, you're unlikely to be able to raise the money as a junior to do that. So my barbell would consist in this space of the best names amongst the larger players, and then a basket of juniors that I think have the right stuff to become takeover potentials. Okay. And if they're an obvious takeover potential that's probably priced in, it may be too late. But that's what I would be looking for. There are small, high-grade copper mines that a junior can produce, 3-4% copper underground or something like that, where they can do that. But they're never large. They're never world-class. They're at best a sweet spot that doesn't last very long. Mm-hmm. So maybe this is a particularly important one to keep that go big or go home dictum in mind.
Right. Okay. Now, we haven't touched on silver yet. The more volatile or uranium. Let's go there first, and then I'll wrap up with silver. Uranium has been an interesting market, and a lot of investors are kind of frustrated that it's not performing to their expectation. What else is new, I suppose, in the junior market? What's your take on the uranium sector right now, Lobo?
Well, if they're frustrated now, they're not paying attention, because not only was uranium carving out a bottom over the last couple of months, which, by the way, I wrote about in my free letter. The recent action was spot. We sometimes refer to the spot price as the sput price. It just demonstrated again in this last week how important that is. So if you look at the uranium chart, it just went vertical due to this the latest round of SPUT doing what it does. So very interesting. But a couple of things. One is I'm a fundamentalist, not a technical analyst. I like it when the technicals agree with my fundamental view. The really important thing here is everybody in this space will tell you that the real market is not the spot market, it's the long-term contract market. The long-term contract market never rolled over. It didn't go high up to $100 and change when I was on stage with you on that famous panel where everybody moved away from me on the bench, calling for correction. So uranium in the spot market got way ahead of the long-term contract price. No surprise, it corrects. Now it overcorrects, it goes way below the long-term. Uranium spot can zoom above and below long-term contract like it's on a rubber band or something, but it can't go too far because that opens arbitrage opportunities. And so it always closes. And it also can't go for too long. So it always closes. And this last oversold condition, was clearly oversold, couldn't go on too long, and it was starting to show signs of carving out a bottom, and it has done exactly what you would expect. So anybody that's still frustrated, I think they're just not paying attention. Of course, Mr. Market doesn't do what we want when we want. But at the end of the day, reality does matter. And absent a Chernobyl scale event, the demand case for uranium is just growing by leaps and bounds. Last week, the Chinese announced that they're planning to double their reactor fleet by 2040. Not just increase it a bit here and there, but double it by 2040. That's not that long in terms of the time it takes to build nuclear reactors. So this is huge. And you've got, the World Bank has done a U-turn on its prohibition against investing in nuclear. There was another international body, I don't remember which one, did the same thing. Even Germany has done a U-turn on this. And, this is an idea whose time has come again. The nuclear renaissance here is just going gangbusters. I mean, even the Japanese, not just restarting their reactors, but they're extending the life beyond 60 years because that's just reality. You've got to have this power. And by the way, none of this needs AI or electric cars or whatever. We're going to need it anyway. Those other things are just tailwinds on top of it. And the supply, there was worries about high prices curing high prices and the low-hanging fruit being picked. Well, that low-hanging fruit is being picked right now, and it turns out that it's pretty prickly. Kazatomprom itself, the world's largest and lowest cost producer, has moved its goalposts. They're achieving their goalposts now because they moved them lower. And I'm not so sure about Cameco, but pretty much everybody else has announced delays, lower output, and cost overruns or just dead ends. Yeah. So this low-hanging fruit, it just did not swamp the market. That fear just turned out to be completely overblown. So I'm extremely bullish. That said, this is so obvious to me, and it's so obvious to the market that many of the, you can't complain about the stock prices not having moved. If your uranium stock hasn't moved, you have to ask yourself about the real merit of its projects. Because all the companies that have something real, they have all moved. I mean, in some cases, literally going from 52-week lows to 52-week highs in the last couple of months. So what I'm saying is I'm extremely bullish, but I wouldn't chase anything now. I mean, it's so obvious that a lot of money has poured into this space, and therefore I'm in the mode of waiting for the next fluctuation. There's always a next fluctuation. I would not chase anything now, especially nothing trading near 52-week highs or multi-year highs or all-time highs. I know it's exciting, and that FOMO gets in there, but no, do not succumb to FOMO. There's always another fluctuation.
Okay, let's wrap our commodity tour with the silver sector. Are you presently allocating capital in the silver industry?
It's always been there because silver is a monetary metal. I like gold. I'm also bullish on copper. How can I not be bullish on silver, which combines attributes of the two? Sure. But its industrial side has made me not hesitant to deploy, but it has made me very picky. Like if copper was zooming and all the industrial minerals were zooming and the monetary metals were zooming, then that would be the time to say, screw it. It's just time to get on this train, right? But we're not there. And there was a lot of excitement about silver breaking out over 37. And I got Rotten Tomatoes thrown at me for saying, hey, this doesn't guarantee it's up to the moon. And then guess what? It corrects. So the answer is I love silver. I'm actually very bullish on silver. It has the potential to deliver in ways that gold cannot because of its industrial side, and that's not a bad thing. That's a good thing. It becomes the win-win metal under the right circumstances. Whereas, you could say copper and gold, maybe they're opposites. One wins at the expense of the other as industrial and monetary metals. Silver combines those two. So I'm very, very bullish, but I'm not a blind bull. And if the kinds of things that can be a headwind for copper come to pass in the near term, they're also headwinds for silver. And I got to tell you, I'm not a TA, but even I, simple, tinfoil hat Lobo that I am, I can look at a double top of silver at 37 and say, that doesn't look like an all clear signal to pile in and sell the farm, right? To go along here. Takeaway is, though, given how bullish I am going forward, if we do get a buying opportunity, I know long-suffering silver bulls, they don't want another buying opportunity. They just want silver to go to the moon now. I get it. I understand. Mr. Market doesn't care, right? So if Mr. Market wrongly hands us yet another buying opportunity, I think that will be great. And I will be keenly, actively looking to add a lot more silver to my portfolio in that space. And if it doesn't happen, I'll be adding anyway. Okay. Maybe not quite so aggressively, I'll still be buying. I'll be looking for copper as well, other things. But I do think silver has a long way to go ahead of us. I don't think we're anywhere near the top of this cycle for silver or gold.
Okay. Now, I've mentioned the Commodity University a few times. We just released your course live for the students. It's an absolute masterclass on geology for non-geologists. The title of the course is Geology for Mining Investors. But as I was watching it, I was like, this is geology for the non-geologist right here, which is funny because you're not a geologist, right? Your ability to communicate the nuance and the terminology, what I found, Lobo, is that after consuming that course, an investor is completely armed to enter a company website, read a press release, read news flow, and just understand the context and what's material, what's not, what they should pay attention to, what they can throw away. The way you broke down so much of the vocabulary, terminology, and meaning and impact. I'm very excited about that course. And
let me jump in because you're saying something that's actually I glad to promote the Commodities University, but this is actually something for investors to think about. Maybe a geologist couldn't have done that course because they all the technical stuff, all the degrees of potassic alteration in their head, all that stuff. It's hard to resist sharing what you know, right?
Yeah.
Instead of just boiling down what you need to know. So maybe there's geologists out there who would be upset that you asked me to do that. But maybe it needed to be a non-geologist. And here's the reason why I interrupted, because I found this in the field. I'll sit there around the campfire with the guys after we kicked rocks at the project, and I'll ask some questions, and I'm trying to get my head into the rocks of what's going on. And then they'll say, "Oh, you really have a good grip of this," or something. And I'm like, "Yeah, but I'm not a geologist." And I tell you, I can't count how many times that geologists have told me, that could be an advantage, because we do get caught up in the weeds. Or we get excited, or we get married to our thesis. We've got a hypothesis of what Mother Nature did here. We got to prove we're right, that sort of thing. Whereas a non-geologist can come up and realize there's a hole in this story big enough to sail a battleship through, that they don't even notice it, right? So I'm not trying to tell the audience that I'm, secretly really am a geologist. I'm still a lay person. I've just been doing this for a long time, and the takeaway for this is, this can be your advantage too. If you look at this and remember, my purpose here is not to fall in love with the rocks or prove my my purpose is to make money and focus on what do I need to know? What do I need to understand? What is, in Rick Rule's terms, the unanswered question? And how do I know when I get that answer? Mm-hmm. And, I'm really keen to see how helpful your course will be for people trying to do that. I'm excited about it.
Yeah, well, no, and I'm thank you. And thank you for playing a role, because when I read company websites, and I've been in this business 15 years, it's very clear to me right away that the content behind the project descriptions, the news flow, it's not written for retail investors to be able to understand, right? It's not in a language that a dentist speaks, right? It's just not. And that was the motivation behind the Commodity University is like, let's break this down so that retail investors can walk into this and walk out of it being able to carry an intelligent conversation about investing in the mining sector and interpret what they read in a press release and understand the value of the project descriptions on company websites. And most importantly, smell the bullshit when they're talking to a promoter at a conference or reading some promotional news, et cetera, et cetera, et cetera. Find the smoke before the fire finds you. And you'll be joining us at the next masterclass on Monday, June 30th. And I'm excited to sort of grill you on some of the course topics, right? And get you to elaborate. And expand.
I'm looking forward to more content. I want to see Adrian's segment because I know he always adds value.
Yeah.
I've got my decades, but he's got like twice my experience in this sector. So you've got some really good teachers there, and I'm hoping I can pick up some things.
Oh, awesome. Yeah. Adrian Day offered a masterclass in royalty and streaming companies, and super fun. Well, I look forward to jamming with you on Monday with the students. Anybody, you can sign up before Monday and attend the masterclass. I'll put a link beneath this video. Check it out, thecommodityuniversity.com. A whole catalog of courses for new mining investors who want to understand these companies, understand how to value opportunities. New courses every single month, as well as a monthly masterclass with myself and some of the instructors. So check that out. Lobo, thanks so much for coming back on the show today. It's always fun jamming with you, and I look forward to Monday.
Thanks.
A discovery doesn't matter unless it's economic. What's the difference between a discovery and a discovery that matters to us as investors? If you throw enough pressure and temperature and acid at a rock, you can get almost anything out. But if it costs you more than the metals are worth, you just don't do it. And this is where the metallurgical studies come in. This is the most exciting drill hole my grandmother has ever seen. That's a red flag. How to tell from Shinola? That's always the question for investors. My name is Lobo Tiggre. I am the Independent Speculator in a phone book-sized feasibility study that if it's done well, you can take to a bank and they will give you hundreds of millions of dollars to build this mine. Understanding the geology is the beginning. It's funny how just something as basic as the rocks ultimately does inform my financial decisions and how I play it. The geology of that suggested it's still open in this direction, and so I was willing to bet on that, and that turned into something like a 20-bagger for us. But if you're going to suffer the headaches of exploring for and developing an asset, you might as well go for the big project that makes it worth having all those headaches.